Okay, we'll start with the first talk of the afternoon. So we're really lucky to have Tim Roughgarden here, who is a professor at Columbia. And so we're doing a brief introduction. So the brief introduction for Tim. So he's been working in algorithmic game theory since, I guess, roughly forever, since the field started. He has a lot of work in classical stuff on price of anarchy, on mechanism design. And recently, he's also at A16Z Crypto. He's gotten very into blockchain and is one of the leading researchers in blockchain generally, but especially blockchain intersect mechanism design and economics. And so, thank you very much for coming to speak.
Thank you, Matt. And thanks to Matt and the rest of the organizers for having me. Really an honor to be here. I think one of my very first professional meetings ever in my career was actually at the Fields Institute. If memory serves, it was 1999, a workshop on approximation algorithms. And this is my first time back to Fields since then, 25 years later, kind of crazy. Also very cool, obviously, to be back here honoring Mark for his very well-deserved Abacus Prize. So very happy about that. And the work I'm going to talk about, this is not the talk I'm giving much as I'm giving talks around different places, but a couple of years ago, Mark was kind enough to come up to Columbia and we hung out for a few hours. And he had seen this paper of mine and a few co-authors on the concept called lever, which I'll talk more about later, which I wasn't expecting at all. I wasn't expecting him to have read it, but he had, and he liked it, and he asked some great questions. It turned out, true to form, he asked some questions and made some conjectures that it just so happened we had proved like 3 weeks before. And of course, all those conjectures were correct, but given that this seems like a topic that interests you, I thought this would be a natural one to talk about today. Okay. Joint work with Jason Milionis, who's a PhD student of mine at Columbia, about to graduate, and also Sia Makamolemi, who's a colleague of mine in the business school at Columbia. Okay. All right. Now, probably you've had this experience. Sometimes you go see a movie and they use this framing device where the opening scene of the movie is not kind of the first scene chronologically in the narrative that's going to follow, right? And so like the most recent movie I saw that had this form was Sinners. There's a bunch of other ones that have done it too. I'm going to experiment with that same format today. So before I tell you why I care about any of the stuff I'm looking at, especially for those of you who like puzzles and want something to kind of think about, in the beginning part of the talk, let me tell you about a stochastic process that I'm going to be interested in. Okay, and again, I'll tell you why later, why I'm interested. So first, just start with regular old Brownian motion. Okay, so like a random walk, but in continuous time. And then overlay on top of Brownian motion, overlay a Poisson process independent. Okay, and so the volatility parameter sigma, that's going to be an important parameter for us. That's the volatility of the Brownian motion. And then the rate lambda of the Poisson process will be another important parameter for us. So those go in parallel. And every time the Poisson process fires, okay, we are in some sense going to correct the Brownian motion if it's wandered too far from where we want it to be. Okay, so it's a bit in the spirit of reflected Brownian motion, except we do allow things to wander outside of the boundaries. Okay, so specifically, whenever the Poisson process fires, if the Brownian motion process is too big, okay, bigger than a parameter gamma, that's the third and final parameter we really care about, gamma. If it's too big, we just move it back to the boundary. We move it back to gamma. Okay. When the Poisson process fires, if the Brownian motion has gotten too far, too negative, okay, below minus gamma, then again, we just kind of bring it back up to the boundary. We bring it back up to minus gamma. And otherwise, we leave it alone. Otherwise, the Brownian motion just sort of continues unperturbed. Okay. So a picture you might want to have in mind would be something like this. Okay. So the 4 X's here, these are the firings of the Poisson process, okay, over this time horizon. The red ones are where no correction was needed, and we could just leave the Brownian motion process alone because it was within the band that we wanted it to be in. And the 2 green ones are ones where the Brownian motion process had veered outside of the boundary and we corrected it. Okay, so you can see here, we brought this back to the boundary. Here, we brought this back to the boundary. There are times when the Brownian motion process wanders outside of the boundary and we just don't happen to notice because the Poisson process doesn't fire at that particular moment. And so the process may wander back inside this band on its own, on its own volition as well. Okay. So I'm going to be interested in this process. So, a question that, some of you might have fun just thinking about would be, what's the stationary distribution of this process look like? Suppose I promise you that there exists a unique stationary distribution, which is true. What does a stationary distribution look like? Or what's its sort of shape? And I encourage you to keep thinking about this in the next several minutes if what I'm saying isn't particularly interesting to you. Depending, you might conjecture, and this is correct, that the stationary distribution looks like this. So on the one hand, you have a uniform distribution, okay, within the band where we're trying to keep the Brownian motion process. And again, if you think about like reflected Brownian motion or kind of reflecting random walk on a line, you're like, okay, yeah, I guess it makes sense. The uniform distribution pops up. And then on either side of that, we have exponential tails, okay, which again, if you have good intuition for, just sort of the Poisson process, again, maybe you could have convinced yourself, yeah, this is kind of what I expected to see, okay? And so we'll want a much more precise understanding of the stationary distribution, but it turns out this is going to play an important role in the main question I want to study, okay? So now let's go to the actual first scene of the movie chronologically. So what question do I want to answer with this work? I want to understand the following question. Do faster blockchains have better markets? And you shouldn't really know what I mean by any of those words. I need to tell you what kind of market I'm interested in. I need to tell you what I mean by better. I need to tell you what I mean by a blockchain. Actually, I don't. You kind of only really need to know one property about blockchains, and this we'll talk. And then how one might say a blockchain is faster or slower than another. Okay, but ultimately, this is the question that we're doing the math to answer. Okay, and this is a question of great interest to practitioners. There's a lot of different blockchain protocols in the world. Some of the teams behind those blockchain protocols work really, really hard to make them as fast as possible. There's obviously performance reasons to do that, but the question is, are there economic reasons to do that as well? Okay, so that was of interest to many people. All right, so let's start with, when I say market, it's kind of a vague term. So what kind of market should you be thinking about? Very simple in this talk, really just buying and selling a single asset, a risky asset, meaning an asset whose price can change. If you like, just think about Apple stock, or maybe like fractionalized shares of Apple stock. That's fine for now, okay? Buying and selling. So what does it mean for a market like that, a market for Apple stock, to be better or worse? Okay, a few things. I want to focus on the adverse selection costs endured by market makers. So what do I mean by that? So a market maker is someone who's willing to take the other side of a trade, okay? So you want to buy a share of Apple stock for whatever reason, you just felt like it today, and then a market maker is likely going to be the counterparty, okay, the person that actually sells you that share of Apple stock for some price that they set, okay? So that's a market maker. It's someone who enables trades, acts as a counterparty for other people who want to trade, okay? Now, is this a good business model? Does it make sense to be a market maker? Okay. Well, you have to think about two things that you're trading off, okay? So on the one hand, you're going to be charging fees, or roughly equivalently, there's going to be what's called a bid-ask spread. Okay, so if I'm a market maker for Apple stock, I might say I'm willing to sell you Apple stock at $252 a share. I'm willing to buy it from you for $248 a share. That $4 between those two prices is the spread, the bid-ask spread. And so that's going to be money that I pocket if I subsequently buy and sell a share, okay? So that's the good news. Okay, from every trade, you're going to be making some money off the person doing the trade with you because you're giving them a service. The downside is adverse selection, okay? And so the economists in the room are all sort of very familiar with this, but it's basically a good instinct, like whenever sort of you make someone an offer and they take it, there should be a little voice in the back of your mind saying, does this person know something I don't know? Like, why did they take it? Why did they just take my offer? I didn't want it at this price, somehow they did. Okay, so you should have a story for why that might be, and whenever there's a transaction. So that's adverse selection. How does that happen with market makers? Well, it happens if you take the wrong side of a trade, meaning you take the side of a trade with some trader who knows more about the price of that asset than you do, okay? So they know that you're either buying too high or selling too low. Now, traditionally in finance, okay, where does sort of this information come from? The historical obsession, for good reason, was about insider information. Okay, so people who work at the company or brother, or their uncle works at the company, and just knows stuff that the market maker doesn't. Actually, in the last, as technology, as this has gone more and more over to kind of the online world, there's been interesting new set of examples where it's not so much that it's like inside information or private information. It's just that whoever is trading with the market maker has found out about public information slightly earlier than the market maker, okay? So if you ever hear about kind of like latency races among HFT, high frequency trading firms, that's really this. It's really someone finding about a price change. Everybody knows it, but someone finds out about it 10 milliseconds before somebody else. And then in the blockchain world, as we'll see, this is really kind of very fundamental of the way these markets work on blockchains like, say, Ethereum or Solana. Okay. So the business of market making is trying to make sure you earn enough fees that it more than offsets the adverse selection costs that you're incurring. Okay. So this is what we mean by markets. What do we mean by a better market? We mean a market which has less adverse selection costs, okay, where there's less sort of loss to arbitrage. Okay. All right. So I don't actually want to think about, a sort of traditional broker, buying and selling Apple stock or something like that. I want to talk about something called automated market makers. Okay. And so this is not, unlike what it said in Wikipedia on the last slide, this will not be a firm or an institution. An automated market maker, or an AMM, will be a computer program, literally. It'll literally just be a computer program. A computer program that has its own bank account and its own brokerage account. That's the way you should think about it. Now, you might say, like, what does that even mean? Like, a computer program is just software. What do you mean it has a bank account or that it has assets? But that's exactly one of the main things that blockchain technology provides. Blockchain technology makes this sentence well-defined. Okay? The computer program is a smart contract hosted by a smart contract chain like, say, Ethereum or Solana, or there's many others. And on a blockchain, you can have just purely digital assets, and they can be owned by a user or by a program in a meaningful sense. Okay? And this is not science fiction. Okay? Like, these things really exist. And in fact, they do kind of tens of billions of dollars of volume per day. That's still only like a few percent of US equities. And US equities is like pretty big. So a few percent of US equities is like nothing to sneeze at. Okay. And it's growing. You might conjecture this continues to grow. Okay. So again, not science fiction. Any of us could right now sort of go and participate in exchanges on, say, Ethereum or Solana that are these AMMs, smart contracts with a bank account and a brokerage account. Okay. All right. So you might say, well, where did that computer program actually get those assets in the first place? So those are provided by parties called liquidity providers. So that's kind of like market making, but in this context, they're passive. Literally, you, instead of depositing your assets into a bank, you would deposit it into an AMM in exchange for a share of the trading fees generated by that AMM. Okay, so those depositors are sometimes called liquidity providers or LPs. All right. So I want to look at adverse selection costs specifically in AMMs. All right. Okay. So a typical AMM is a market of the type we just said. Okay, really, there's just kind of one risky asset, being bought or sold. I mentioned Apple stock. Like right now, it would typically be a cryptocurrency, like, say, ETH or something like that. Honestly, we're probably about within 6 months away from like it literally actually being digital representations of Apple stock. And that's probably going to happen like very soon. Okay. So if you want to keep thinking about Apple stock, that's fine as well. All right. Now, why is it called automated? What's the A for? Well, an AMM, at least most of them, programmatically commits to a price schedule. Okay, so the price at which they will buy or sell assets from you as a function of the reserve they have of those assets right now. Okay, so X here denotes the quantity of the assets, so like the number of shares of Apple stock that I currently are in possession of. P of X is the price at which I'm willing to buy or sell one share of Apple stock to you. Okay, and this is just code. This is just part of the program, part of the AMM's code. Okay, so it's a programmatically defined price schedule. This function P, for our purpose, so it makes sense for it to be decreasing. The less you have left, the more you're going to charge for what's remaining, and it's going to be important for the math that it's smooth. Okay, that this is a sort of continuously differentiable, strictly decreasing function. Okay. Other than that, we're not really going to care what P is. Okay, so different AMMs can experiment with different choices of P. Okay, and that's a good thing. It's good for different AMMs to compete on designs. If you want something very concrete to have in mind as we go through the talk, sort of the OG AMM, like Uniswap, would correspond to the price schedule, a constant divided by the remaining reserves squared. Okay, so if the constant here was like C, right, and you had 1,000 shares left, you'd be willing to buy or sell one at a price of 1. But if you have only 1 share left, you'd require $1 million to sell that last share that you've got. Okay. So again, in general, we're going to have a smooth, strictly decreasing price schedule. That's just one simple example. Okay. So let's talk about adverse selection now, specifically in the context of automated market makers. So one thing that's sort of funny about these AMMs is that, they're kind of programs that just exist and just don't change until some user interacts with them in some way, okay? Like doing a trade, okay? If nobody interacts with the contract, X stays the same, so P of X stays the same. Only with a trade does X change, and therefore P of X change, okay? And so that means, as we'll see, it means the price of the AMM may become out of date. It may become stale, okay? So let's think about the case where some agent, some arbitrageur, is able to acquire an asset for a price of, is able to sell an asset for a price of P star. Okay, so for example, in the open market, okay? If the price of the AMM is less than P star, well, then the arbitrageur can just make free money by buying low and selling high. Okay, so in this case, you would be buying from the AMM, because the AMM's price is less than what you can sell at elsewhere, and you could turn around and flip it at a price of P star, and you would pocket the difference. Okay? So if the AMM price goes too low, arbitrageurs will buy from it to push the price back up so it matches what it is on the open market. Symmetrically, if the spot price on the AMM is too high, okay, meaning that on the open market, the price has drifted down to P star, well, then again, you can buy low and sell high. In this case, you're going to be buying on the open market at a price of P star, and then selling back to the AMM at a price at the AMM spot price. And you will continue to do that until you drive the AMM's price back down to P star to match what it is on the open market. Okay, all trading up to that point is strictly profitable for you. Okay, or at least this is how it would work if the AMM is charging no fees. Okay, and we'll extend that in a second. And so this is what I mean by adverse selection costs. Okay, so as an arbitrageur in these cases, this is someone who's literally just making money from nothing. Okay, they had nothing, they did a couple of things, and they have money. Whose money was that? Well, that must have been the money by the liquidity providers that supplied liquidity to the AMM. There's a zero-sum game going on between arbitrageurs and those making markets possible, mainly those in the liquidity providers. Okay. And in general, for a market to be healthy, you need to have incentivized liquidity providers, right? You need to have liquidity for people to trade, which means it has to be worth it for the depositors to actually put those assets in the market. So to have a well-functioning AMM, it is important that the LPs are happy, and so it's important that these adverse selection costs are not too high. Okay, you may not be able to drive them down to zero, but they should be not too high. So when I talk about adverse selection costs, what I mean is profit to arbitrageurs. We will identify that with adverse selection costs. So if there are fees, and there are in practical AMMs, and gamma is not an accident here, vis-a-vis the kind of opening scene. If there are fees, then similar reasoning holds, okay? So let's imagine now that with every trade, the person doing the trade has to pay a fee, okay? And these fees in practice, and I encourage you to think about them as small, 1%, 0.3%, something like that, okay? For notational convenience, I'm gonna express this fee not as sort of a gamma fraction, but rather in the exponent. Okay, so e to the gamma minus 1, which for small gamma is basically the same as gamma. It just makes the notation a little neater. Okay, so you must supply an extra little bit of whatever it is you're paying for. So if you're buying Apple stock with cash, you need to pay roughly a gamma fraction extra amount of cash to get that amount of Apple stock. Okay, and so now it is not the case that it makes sense to arbitrage an AMM just because its spot price has drifted a little bit away from what it is on the open market. But if it's drifted far enough, right, it's still going to be worth it. So if the price on the AMM is a lot less than the open market price P star, specifically less by e to the minus gamma factor, well, then again, same reasoning. You can buy low, sell high. You can even absorb the trading fee. You're still going to make profit. So you're going to be buying from the AMM again until you drive the price up to the break-even points. Okay, now it's not P star, now it's P star, roughly 1 minus gamma. Okay. Similarly, if the price of the AMM is well higher than P star, okay, so bigger than roughly a 1 plus gamma factor of P star, well then it's in the arbitrageur's interest to sell to the AMM until until the price of the AMM and that on the open market differ only by that e to the gamma factor. Okay, exactly the same reason. There will be this now non-trivial interval where if the spot price of the AMM is sufficiently close to the price P star on the open market, actually there's no profitable arbitrage trade. Okay, so nothing's going to happen in that case. All right, so let me do this slide and then I'll pause for questions. Okay. All right, so adverse selection costs mean arbitrage profits. Arbitrageurs have an opportunity for profits whenever the spot price of the AMM goes too far from the market price. So let's now talk about why spot prices on AMMs do regularly drift quite far, potentially, from the price on other markets, okay, on the open market. Okay, and this is the one property about blockchains that's important for this talk, which is unlike, your laptop or something like that, which for all practical purposes is running like continually. Or even if you go to kind of just, I don't know, if you go to your brokerage firm and do some trades, it's going to seem like it's just running continuously. A blockchain protocol is not like that. Okay, so what's the block for? It processes transactions, it does computation in batches known as blocks. Okay, so there's a heartbeat to every blockchain protocol. Boom, boom, boom. At every beat, that's when a bunch of computation gets done. In between two beats, nothing happens. Nothing happens on the blockchain protocol. Okay, no trades get processed, no arbitrage trades get processed, nothing else at all. Okay, you might say like, well, why, right? So if you have like just a normal centralized exchange, so like in the context of cryptocurrencies, this would be like Coinbase or Binance or whatever. Again, you just sort of interact with it, and it's for all practical purposes running in real time. So why not blockchain protocols operate in real time? Well, it's because they want to be decentralized, meaning there's no single owner. Okay, meaning the state of the blockchain protocol is the result of sort of coordination among many physical machines, ideally with different operators. The idea being that a centralized exchange could just sort of go offline overnight. AMM that lives on a blockchain protocol, shouldn't go offline unless the entire internet goes down. Okay, so they're going to be much more robust. And there's going to be much less control by any one party in an AMM on a blockchain protocol than there is in a centralized exchange. But the price you pay for that decentralization is you have to periodically have all of the physical machines running the protocol come to consensus. Okay, it's crucial that they all have a shared view about exactly what transactions have been processed and in what order. Right, so if Alice tried to pay Bob and Alice tried to pay Charlie, everybody has to agree which one is the actual valid transaction. Okay, there can't be disagreement. So the heartbeat is to give all of those physical machines time to come to consensus on exactly what happened in the last 100 milliseconds, 10 seconds, whatever it is. Okay, so that's the one thing to know about blockchain protocols, okay, is the computation happens periodically, not continually. Okay, now price discovery on a centralized exchange like Coinbase or Binance basically does happen continuously. Okay, those are not blockchain protocols. Those are just traditional big tech companies, okay, running big servers themselves. And so what that means is that if there's some event in the world which changes everybody's perception of the price of an asset, okay, for whatever reason, who knows, like maybe some blockchain protocol suffers a liveness bug or something like that, and the corresponding cryptocurrency is then going to have a big drop in price. That is going to show up first, it'll show up basically immediately at a centralized exchange. It will not show up on an AMM and a blockchain protocol until the next opportunity the blockchain protocol has to do processing, okay, until the next heartbeat. Okay. Which means every single block, okay, every single time there's a heartbeat on the blockchain protocol, there's a possibility that since the last heartbeat, the AMM price is stale. Okay, like as for a concrete example, Ethereum, okay, which is the biggest smart contract platform, second biggest blockchain around after Bitcoin, the heartbeat's every 12 seconds. And 12 seconds is a long time in finance when you're talking about sort of prices of volatile assets, okay? So every 12 seconds in Ethereum, okay, a new block gets processed, and at the beginning of that block, the AMM spot price is still what it was 12 seconds ago. And a lot could have happened in the meantime, okay? And so that's why it's very frequent that for AMMs on blockchain protocols, you do have these arbitrage opportunities. Okay, not because of private information, but just because information is available to arbitrageurs earlier than it's available to the AMM, and they can make trades at these stale prices. Okay. So when we talk about, at the beginning, I asked this question about do faster blockchains have better markets. So faster is going to mean a faster heartbeat, right? So less time between beats. On the one hand, it's obvious that, the more blocks there are, okay, the more frequent the beats, that's the more frequent the opportunities for arbitrage, right? Every time there's a new batch of transactions get processed, that's a new opportunity. So that seems bad. The good news is that presumably there's been less time for the AMM spot price to drift out of date. And it's not immediately clear how those two terms push and pull against each other. Okay, that's something we're going to try to resolve. Okay. All right. So back to the question. I've now defined informally what I mean by most of these terms. Do faster blockchains have better markets? Market, again, just going to focus on a very narrow but important kind of market, buying or selling a single risky asset, tradable asset. Better is going to mean less adverse selection costs, which we identify with less arbitrage profits. Okay, so either the opportunities are fewer or they just generate sort of less profit when they come up. Faster means a faster heartbeat for the blockchain protocol. It means more frequent processing of transactions, a smaller pause between different batches of transactions. Okay, and again, I mentioned this earlier, but modern blockchain protocols work really hard to produce blocks as fast as they can. Okay, so Ethereum is kind of a couple generations ago, 12 seconds. Lots of different blockchain protocols work really, really hard to get below a second, for example. Okay. The obvious reason to do that is just kind of performance, right? If you're interacting with a blockchain protocol and you issue a transaction, meaning you instruct the blockchain protocol to carry out some instructions on your behalf, you would like confirmation that that has in fact happened as soon as possible. You don't want to wait, right, on your phone or sort of on your web page for 12 seconds. You would like under a second. They say, got it, done, get on with your life. Okay. But what's interesting is this question is, are there economic byproducts, benefits as well? Okay, and that was not, the performance benefits are obvious. Whether or not there are economic benefits was not really obvious. Okay. All right, so questions up to this point? Yep. I think from an economic perspective, it's not immediately obvious. Because you could have arbitrage like all the time, right? So you might hope, or I don't know, you might wonder, I don't think it's, again, there's sort of two forces pulling in different directions, right? The faster they get, the more frequent the arbitrage opportunities. So that seems like a bad thing. But presumably any given arbitrage opportunity is going to, like on average, be less profitable because not as much has happened since that time. And so like, do those cancel out? Or is one more powerful than the other? That's what we want to get at. Yeah.
Ability to charge the volume, but essentially somebody's, if you have a trading bot, you can essentially automate largely the same thing, but you don't have the ability to charge fees.
Yeah, I mean, there's a couple of things. I mean, there's also the issue of custody, like where do the assets live, right? I mean, so what's blockchains are really good at is custody. Like that's where the assets live, and you can own them, and you can trade with someone, and at all times, you either own the assets you started with or you own the assets that you bought, and there's no in between. So there's other reasons. To be honest, I mean, at this point, I'm kind of like, these things are real and tons of people use them. So at this point, I think they're interesting to study. So I would say, yep. Say it again. I can't hear, so. Yeah, because the blockchain doesn't know what the price is in the New York Stock Exchange. So this is part of the design space that people are exploring, but certainly like for the first generation, the question would be like, how do you in a reliable way? I mean, this in general is I'm not saying it's an unsolvable problem, but it's a non-trivial problem to reliably get information outside of the blockchain state into it. Yeah. But definitely like newer generations of AMMs often do have some aspect of these so-called oracles from the outside world. Yep. Yeah, so again, that was first generation. And so the theory I'm presenting today is quite general. I just give you that for, if you want a concrete mathematical example to keep in mind, why not choose the very first one? There is actually a very nice paper by Jeff Ramsayer and others that basically gives sort of a post hoc explanation for x, y equal k, that in effect, if you're a market maker with certain beliefs about future price trajectory, there's a sort of worst case sense in which that is actually a good curve to do. So that was an open question for a while, but there's, it's called Finding the Right Curve, I think is the name of the paper. And that's quite nice, actually. That said, I mean, for today, I offer it just as a, for those of you that have never seen this, that's just a simple thing to keep in mind. Yeah. Yeah. No, generally not. I mean, it's a program, so you can code it however you want, but the typical ones will process as many trades as there are in the block. So. Correct. But so for example, I mean, things are much more complicated now, but sort of in the early days, basically you would just bid high to the blockchain, hoping that you would be put first in the block so that you would get to take advantage of the arbitrage. Yeah. Great. Okay. So let me start filling in more details of the model so we can actually sort of reason about this question. So there's a couple components I really need to tell you the plan. So first of all, it's going to depend on the price trajectory, of this asset, right? So in particular, if you have an asset whose price never changes, there's nothing to worry about. There's never any arbitrage opportunities. If you have an asset that's super volatile, you might expect there's going to be a lot more arbitrage opportunities and a lot more adverse selection. Okay, so let's start with that. We're going to just use the kind of textbook chapter 1 model for kind of the evolution of the asset's price in the geometric Brownian motion. So some of you will know this very well. For those of you who haven't seen this before, not in a long time, right? So regular Brownian motion, again, it's just kind of like a symmetric random walk, but in continuous time. There's one parameter, okay, of interest to us, which is sort of the volatility, sigma. So in regular Brownian motion, it really just means you're kind of accumulating variance at a rate of sigma squared over time, at a constant rate of sigma squared over time. Okay, so if you look at the difference between two different moments in time, then it's the time interval length times sigma squared is the amount of variance you have between those two, and it's Gaussian. Okay. So geometric Brownian motion, you just, rather than, you do the random walk in the exponent, in effect. Okay. Or another way to think about it is now you accumulate variance in a way that's sort of relative to the current price, rather than just sort of a constant over time. Okay. So again, if you've never seen this before, just think of it as like you're taking a symmetric random walk, but sort of in the exponent. So random walk on returns. Okay. What, did you gain 1%? Did you lose 1%? As opposed to, did it go up $1? Did it go down $1? Okay, so that's geometric Brownian motion. Okay. Technical detail, if you think about it like by the AG inequality, like, while +1 and -1 are inverse operations, like increase by 1% and decrease 1% are not. So just to make it so that sort of the log prices are a martingale, we sort of have a little drift correction so that basically that all evens out over time. Okay. So that's the assumption about how prices evolve, and sigma is the important parameter here. Okay, so sigma is the volatility of the asset that this market is for. One out of the 3 important parameters. All right, we also need a model of block generation. Okay, we said that there's this heartbeat, or that sort of blockchain protocols process periodically. How do we talk about that? And we're going to assume that blocks are generated at times according to a Poisson process. Okay, so at any moment in time, there is some constant instantaneous chance, if you like, that a block will be generated at that particular moment in time. Okay, and we then interpret faster blockchain as being a larger value of lambda. Okay, think of lambda here as the number of blocks you're expecting to see in a day. Okay, so like if you had a 10-minute block rate, which is what Bitcoin is, that'd be 144. Ethereum, which is 1 every 12 seconds, that would be, I think, something like 72,000. Okay, so big numbers of lambda, but bigger lambda means faster blockchain, more blocks per day. Okay. Now you might say, why a Poisson process? And I'm going to be honest with you, when we first did the work, first version of the work, it's because that's what we could prove stuff for. Right? Totally honest. That was the reason. It's not really what we wanted. It is true that for a proof of work blockchain like Bitcoin, this is actually exactly right. This is actually exactly the distribution at which blocks are generated in a proof of work protocol. Proof of work protocols are not where the AMMs live, though. In general, because the proof of work protocols don't actually have general smart contract programming functionality, the way the proof of stake protocols like Ethereum, Solana, et cetera, do. And Ethereum, Solana, et cetera, actually have deterministic block times. Okay, so it's every 12 seconds deterministically in Ethereum, every 400 milliseconds deterministically in Solana, okay, more or less. Okay, so this was really just an approximation for us. All right. Now, what's been really cool, and honestly, when we first did the work, we were a little unsure about, we were hopeful that the results would be very robust to this assumption, but we didn't really know. And since then, a couple of cool, like some really nice pieces of follow-up work have been done. On the theory side, Nizlobin and Tassi actually show that all of the punchlines I'm going to show you later in this talk continue to be true no matter what the block time distribution is, in particular for deterministic block time distributions. Okay, the punchlines will remain the same. Now, they're not a strict generalization of our work. They're sort of incomparable because we're going to make basically no assumptions about the AMM other than that function P is smooth. Okay, so it's very general with respect to what AMM you can work with. But again, we make the specific block generation process. Nizlobin and Tassi make a general block, sort of block rate, have a general distribution there, but only work with, I'd say, a very cartoon model of an AMM, okay, where you basically always have constant marginal liquidity, okay, which is not how regular AMMs work or can work. But we still take this as really good evidence that the Poisson assumption is not critical for the punchlines of this work. And then there's also a very nice empirical paper by Fritsch and Canidio, where they take actual AMM data, trading data, from Ethereum, et cetera, and they literally just kind of look at the statistics that we discussed. In particular, there's a square root law I'm going to emphasize, and they show that, to first order, the data actually conforms very, very well to the predictions that this theory gives. Okay. So again, if your first reaction is that this is cheating, I sort of sympathize, but it actually seems like it adds tractability without losing much as far as accuracy. This is what it seems. So let's put it all together. Okay. There's going to be, so we have a model, and there's 3 parameters, okay, that are going to be really important. Same 3 parameters in the opening scene. All right. So sigma, that's the volatility in the price trajectory of this risky asset that's following geometric Brownian motion. We have lambda, the intensity of the Poisson process generating blocks. Okay. Higher lambda means faster blockchain. And then there's also going to be the phi, gamma, that I mentioned. So to talk about that, let's define ZT. Okay. So this is going to be the mispricing process, kind of induced by the AMM. And induced by the price evolution of the risky asset. So we're going to be interested in how much the spot price of the AMM differs from the price on the open market. Okay, and we're actually going to look at how much they differ in the exponents. Okay, so we're going to look at the log of that ratio. Okay, this is by our, remember we had that sort of we added the drift exactly so that this is just regular Brownian motion with volatility sigma, no drift. And whenever the Poisson process fires at time t and some block is generated, the arbitrageur is going to do what arbitrageurs do, okay, which is maximize profit. So if the price on the AMM is sufficiently low, okay, which in this notation corresponds to ZT being big, ZT being bigger than gamma, well, then the arbitrageur will buy from the AMM as long as it's profitable, which means buy from it until this gets boosts up to the point that ZT equals gamma, so snapping to the boundary, if you will. And if the price on the AMM is sufficiently high, okay, meaning which maps onto ZT being less than minus gamma, then again, it sells to the AMM as long as it's profitable, which is until ZT becomes equal to minus gamma, okay? And otherwise, the Poisson process fires, and neither of these 2 things are true. ZT remains unchanged. No trade happens. Okay? And so here's gamma. Okay, so sigma, lambda, and gamma. Volatility, sort of speed of the blockchain, and the phi. Okay. And so this you will recognize is the same process that we started with at the beginning. Okay. So the Brownian motion, which is sort of the evolution of, again, sort of this mispricing process. So the evolution of the difference, or sort of the ratio, the log of the ratio between the prices of the spot and on the open market. The Poisson process corresponding to block generation, and then the sort of resetting to the boundary corresponding to behavior by arbitrageurs. Okay. This is the log of the ratio between the prices on the AMM and on the open market. Yeah, yeah. So here's Z right here. Yeah. Okay. Great. All right, so we want to understand how adverse selection costs or how arbitrage profits depend on lambda, depend on the speed of the blockchain protocol, okay? So let me just do a little bit of setup, and then we'll start talking about the stationary distribution of this process and what that does for us. Yeah.
Back to the previous question.
Yep.
Again, because of the number of transactions between the flow, more complicated to use this arbitrage, as I don't know now, as I see that at the beginning of the flow, I could make money, but if a lot of players will try to do the same thing at the same time, some of us will lose. So how exactly do I?
Well, that's sort of not my problem. For this model, all I need is that one arbitrager succeeds in being at the top of the block, and then the process is accurate.
But doesn't this make it harder for the arbitrager to make this decision because it doesn't know if you actually make this?
I'm not trying to sort of microfound the behavior of arbitrageurs in the midst of competition. I am assuming that if an arbitrage opportunity exists, that it will not be left on the table. That is the only assumption for the model. So, good. All right. So we want to quantify arbitrage profits, which again, we're identifying with average selection costs. Smaller arbitrage profits means a better market, okay? So what's the quantity we care about? Well, we can look at some time, time horizon up to capital T. The Poisson process fires some number n sub t of times, and then we just look over all of those n sub t arbitrage opportunities, the profit that's generated for the arbitrageur at each moment in time. So this is notation I introduced right here, okay? So when when a block is processed, there are three cases. In each of the three cases, there's some corresponding profit to the arbitrageur. It's going to be 0 in the third case. It's going to be positive in the first two cases. And how much profit it is going to depend on just how far the AMM spot price is away from P star. But you could imagine writing down a formula for exactly this. Okay, so this is just the money that the arbitrageur makes when it does the best of these three options. Okay. So what we care about is the sum of the arbitrage profits over all of the potential opportunities, all of the times that the blocks were created, okay? And we're gonna focus on sort of the time average of this, okay? So we're gonna think of this as kind of like almost like at each moment in time, there's some sort of expected amount of arbitrage profit we're expecting to be earned. And that's the number we wanna focus on. Okay, so that's gonna be R bar, okay? And again, better market just means a smaller value of R bar. So it's sort of in a time average sense, arbitrageurs are making profit at a smaller rate, okay? So this is going to depend on a few things. So first of all, it's going to depend on properties of the asset. So certainly on sigma, again, bigger sigma, you would expect more losses to arbitrage. It depends sort of, it does depend on the initial asset price just because we're doing, geometric Brownian motion. So it's going to be scaled with the initial asset price. It's going to depend on the AMM. So both kind of the price schedule, which is what I mean by capital M, also on the fee. Okay, that's part of the AMM's description. And then it's going to depend on the blockchain speed lambda. Okay, all of these things are going to be relevant for understanding this number. Okay. And so really the key question comes down to fixing everything other than lambda. So fixing the AMM, fixing the asset, okay, which we think of as sort of out of our control if we're designing a blockchain protocol. How does the adverse selection cost depend on the blockchain speed? Depend on lambda. Okay. And if faster blockchains do have better markets, how much better are they? Okay. All right. So now let me get back to the stationary distribution. The other thing I give you a sort of foreshadowing of at the beginning. So as we already discussed, the shape looks like this. It's important for us to know, we want to do a very quantitative analysis, so we want to know exactly what that stationary distribution is. And so the way I encourage you to think about this with sort of the parameters we're interested in, gamma is pretty small, right? Again, gamma is going to be like 1% or 0.3% or something like that. So this uniform region, okay, where this is where arbitrageurs do nothing, this is where there's no profitable trade. It's going to be pretty skinny. But I also want you to think about there possibly being a lot of probability mass in here, like maybe 50%, like maybe half the mass is in this little skinny region. Okay, so it's going to be very tall. Okay. And then you have the exponential tails, and the density function matches up. Okay, so where they're glued together. So these are going to be sort of exponential PDFs that start very high up, and they're going to drop very quickly. Okay, so the exponent in these exponential tails is going to be this √2 lambda over sigma. Okay. And I know this just looks like Greek letters at the moment, but actually, if you think about it, sigma over square root of lambda has a very definite meaning, okay, which is we're right? So 1 over lambda, that's the time you expect between blocks. So that's like some t. So like 1 over root lambda, that's like root t. And then sigma is the volatility, right? So we're seeing a sigma times root t in effect, which is just sort of the expected sort of drift. It's the amount of change you expect in this process over 1 block arrival time. Okay, so that's the way to interpret sigma over root lambda. Okay. All right, so skinny uniform region, and then exponentials with sort of very quickly decreasing tails. Okay. So it turns out a really important number for us is the amount of the probability mass that's in the tails. Okay, the likelihood with which there actually is an arbitrage trade in a given block. Okay, and this is something you can characterize precisely. Okay, this does not depend on the AMM, except in as much as it depends on the phi gamma. Okay, it does not depend on capital M. Okay, so it does depend on the speed of the blockchain and the phi and the volatility. Okay, so that's the probability of trade. And the main thing I want you to notice, again, we're sort of be thinking of everything fixed but varying lambda. As lambda grows large, okay, this term is going to dominate. Okay, this will be the big term. We can sort of ignore that, which means this is going to scale like 1 over square root of lambda. Okay, so that's sort of important. It makes sense, right? The faster the blockchain, holding all else equal, the faster the blockchain, the less likely any given block will have an arbitrage opportunity, because again, there's been less time for the price to drift, but it's not necessarily a priori obvious that it's going to be as 1 over square root of lambda. Okay, but that's what it is. Okay. All right. So this is not the only thing that affects adverse selection costs, right? So obviously, the higher all else equal, the higher the fraction of blocks that have no arbitrage trades, the better for us, the better the market. That's not the only thing going on. What turns out, this is the dominant factor, though, in the adverse selection quantification. Okay. Maybe I'll skip that. All right. So let me just sort of get to the results and then wrap up. So this is what we want to know. We want to know for a given AMM, what's the rate at which arbitrageurs earn profit as a function of all those parameters. Okay. And now we know the stationary distribution, right? We know now exactly what that sort of mispricing process looks like. So one idea would be, okay, well, to figure this out, just sort of integrate, right? So for any given value of z, we know what the corresponding arbitrage profit is, right? So if z is in the middle, that's going to be 0. If it's in one of the tails, it's going to depend on sort of how far out in the tails it is. But whatever, there's going to be some formula. It's a function of the price schedule P. There's going to be some formula telling us what the arbitrage profit is. Okay, so just integrate over the distribution that we know governs z. Okay, so that's sort of the first idea about how you compute this. And it's not obvious how to do this fully generally, because again, we're assuming very little about the AMM. It's just some smooth, strictly decreasing price schedule. It could be super weird. Okay, and if that price schedule is super weird, maybe this function is super weird. And then even though I do know a closed form formula for pi, how do I integrate something arbitrary with respect to pi? At least how do I do that exactly? Okay, not clear how to do that. So there's 2 things you can do, and we do both of them. The first one is you can say, well, let's look at sort of AMMs where the price schedule is nice. And we actually can just integrate out over the stationary distribution and get a closed form solution. We don't view that as our main results, but that is something you can do. It's helpful. So for example, if you go back to the original sort of C over X squared AMM, so sort of the original Uniswap, the expression for how much money an arbitrageur makes as a function of the mispricing, yeah, it's not that simple, but you can manage it. Okay, so you actually can sort of do the integration and get a closed form solution, and this is what you get. Okay, it turns out. All right, this is sort of normalized in a particular way, which I'll sort of skip. All right. So the main point here is that if you have a sufficiently simple AMM, okay, with a nice price schedule, then because we also know exactly what pi is, you actually can, in some cases, get closed form solutions for the rate at which arbitrage profit accumulates. Now, what should you take away? Okay, so we solved it, so what? Okay, what does this tell us? This tells us 2 things, okay? And these 2 things are both going to generalize to basically arbitrary AMMs. Okay, so let's just observe them in this closed form solution, and then I'll show you the theorems that say those observations hold more generally, even if you don't have such a closed form solution. Okay. All right, so the first thing to notice, all right, so there's sort of like this weird condition here, but just what parameter values should you be thinking about? Lambda is really big, Okay, lambda for Ethereum, again, it's like 70,000 or something like that. Sigma, this is daily volatility. So you want to think of this as like something like 0.05. Okay, so this holds by like several orders of magnitude. This is fine. And more generally, because sigma is small and lambda is big, this is tiny. Okay, so this is basically just this e to the gamma over 2. Furthermore, we're thinking about gamma itself, the trading fee as being like 1% or 0.3%, in which case this is really not that much different than 1. Okay, so you can almost think of this as sigma squared over 8 times the probability of trade, which we just characterized, which is here. Okay, so what we see then, okay, again, sigma squared over 8, that's a constant. And again, holding sigma and gamma fixed, P trade scales as 1 over root lambda as lambda grows large. So we already observed that if you have like 4 times as fast a blockchain, you're going to have half as frequent the arbitrage opportunities. But this actually says you will even have half the rate of arbitrage losses. Okay, so if you 4x the blockchain speed, you'll get a 2x improvement in the adverse selection costs. Okay, that's what you can take away from this formula. And then the second thing, which I don't have a lot of time for, but so the paper that Mark asked me about at the beginning of our meeting, this lever paper, lever stands for loss versus rebalancing, this sigma squared over 8, so this is with the same co-authors, Jason and Siamak, but also Anthony Lee Zhang, who's at the University of Chicago. So we had a sigma squared over 8 in that paper, okay? And so in fact, you can think of this earlier paper as the special case of the current question. Did I lose a slide? No, here, sorry. You can think of this previous paper as answering the specific question where the fee is 0, okay, so arbitrage is frictionless, and where the block rate is infinite. So literally you have constant arbitrage at every single moment in time. So that's what this previous paper did. It quantified adverse selection costs in this particular case. And so what we're seeing is that in the general case, or at least for the C over x squared example, things are not much more complicated. You have the same adverse selection costs you had in the earlier case with no fees and infinite block rate scaled by the likelihood that any given block has an arbitrage opportunity. And again, that likelihood is what's scaling as 1 over square root of lambda. Okay? So those are the 2 things to notice. First of all, the 1 over square root lambda scaling. Second of all, that it's really just kind of this lever from the previous paper scaled down by the probability that you have an arbitrage opportunity. And it turns out that those 2 observations are general, okay? So it turns out now for any AMM, so it's not C over x squared, it's literally anything, you need like a little bit of a technical condition on the bounding the convexity of the sort of arbitrage profit maximization problem, but with minor technical conditions for any decreasing smooth function P, those same qualitative conclusions hold, okay? So it is again the case that for small lambda, which is what we're interested in, and large lambda, which is what we're interested in, the rate at which arbitrageurs generate profit is just the lever from the previous paper. And again, the point is this is a constant, right, independent of lambda, times the likelihood that a block has an arbitrage opportunity. This is not independent of lambda. This is like 1 over root lambda plus lower order terms. So lever is going to be different for different AMMs. The rate at which you generate arbitrage profits will be different for different AMMs, but for each fixed AMM, as you vary lambda, as you speed up the blockchain, that profit is going to be dropping like 1 over square root lambda. So again, 4x the blockchain speed, you're going to half the rate at which arbitrage profits accrue. Okay. So this turns out to be true in general. All right. So bringing it back together, do faster blockchains have better markets? Yes, they do. We saw that. And we wanted to know by how much. And we have this square root law. Okay, so again, 4x the blockchain speed, you're going to half the rate of arbitrage profits. Again, mathematically, this is for sufficiently large lambda, sufficiently small gamma, but those map on actually very neatly onto the parameters that are actually relevant in real world blockchain protocols. Okay. And that's just another way to think about the same thing. So in effect, another way to think about these results is that if you only have blocks that are only half as often, you might at first think that the total amount of arbitrage profit would be only twice as much because only twice as much time has gone past. But in fact, it's the amount of time raised to the 3 halves. So in fact, the amount of arbitrage profit per block is super linear in the interval between successive blocks. This is another way to think about this idea that actually faster blockchains really give you better adverse selection costs. So let me wrap it up there. Congratulations to Mark. Thanks to all of you.